I made a video on PayPal some time ago. I made it around October last year. Stock was trading at around $53. I said I would probably buy the stock if I didn't already own Amex. Well, I don't own Amex anymore. It has performed quite well. First, the honey scandal dropped, where the honey was basically replacing cookies to claim the commission. And now the stock has gone down massively, back to $70. So let's see, the company has developed. Are we buying the stock? They're showing that growth is still ahead, that they're returning to profitable growth when it comes to the transactions. And this is where kinda people were worried with PayPal. That the transaction business is gonna have heavy competition, which it already did, and it still has. And that PayPal, while not disappear, no one ever said that PayPal is gonna disappear, that they're gonna be squeezed by the other competitors, margins are gonna be compressed, revenue slowly shrinking, and they finally return to growth there. It's not huge growth, 5%, but it's still growth. We're also focusing on their share buybacks, which is a key aspect of the investment thesis right now, that the stock is so low that they can buy back heavy amounts of shares. They're expecting $6 billion in repurchases in 2025. That would be nearly 10% of a company. However, stock-based compensation is still high at 1.2, so in reality, you will only see around $5 billion of that, which would still be a very good yield, but it's not as much. Then it's also important to know, what does PayPal think they need to focus on? They're trying to win over checkout. They just want to get the highest converting checkout. What that means is, you go to a checkout, how likely is it that you're gonna press on purchase? And delivering a small difference there is very valuable to merchants. Let's say if you offer PayPal, you get a 5% higher checkout conversion. That improves your revenue instantly, massively. Let's say 50 to 55, that is already 10% extra revenue. And you're willing to pay more for that. They're trying to go beyond e-commerce though with PayPal debit card. They want to be the only thing you pay with. That's also Venmo for between people. I don't really get the hype behind Venmo, to be honest. For me, it's just another PayPal. But in America, it's popular. That is still the growth engine right now in the business. However, lower margins, less net income. Total payment volume growing 10%. This is also where you see that Venmo is once again lower margin, because their transaction margin only grew by 7%. Revenue as well. Free cash flow up 60%. Very nice in free cash flow growth. However, that free cash flow started at a very low point. We can see they had a huge dip, so it was just a recovery. When we look at the total free cash flow, it is continuing to go up. It's just a growing company still. Active accounts, 2% growth. You're not gonna get huge active accounts growth, because nearly everyone has a PayPal account. I'm surprised they're still growing at 2%. This is like when I see that Meta is growing their accounts by 3%. However, what I like to see, number of payment transactions growing faster, 5%. This needs to outpace active accounts growth. As you can see, transaction per active account, 3% growth. That is fantastic. What am I guiding for? 4 to 5% transaction margin growth. That's the most important part of their revenues. It makes up to 50% of their revenue. So they believe they will grow at 5% right now. And this is the issue with PayPal. The low growth at the moment. You get 5% revenue growth. That's not bad, but it's not a fast-growing tech stock anymore. And while their take rate has finally stabilized, they need to now increase the underlying growth. Competition is very high right now. Buy now, pay later. PayPal is trying to compete. They're fighting against Klarna, Afterpay, Apple. They're fighting against Stripe when it comes to payment processing. They're fighting against Apple, Visa, MasterCard when it comes to payments. They're fighting against Google as well there. They just have a lot of competition right now. And this revenue, if it only grows by around 5 to 8% right now, they're not gonna get very high multiple. I do not think the stock is gonna go away. I think PayPal is gonna be able to compete, but for the time being, they will not have very high revenue growth. Maybe in 5 years, the situation is gonna change. They're gonna have squished some of the competition, but for now, it's gonna be very tough. I do not really see them growing faster than 7%. I think it will be around 6%. However, when we look, they're guiding for 6 to 7 billion in free cash flow. Basically, all of that is gonna be returned to share repurchases. They don't have any excess cash right now. They already put that into share buybacks. So I don't see them increasing it much, maybe a little bit, but they're not gonna go into heavy debt. They probably also want to be ready to do some acquisitions. They did that before especially, but right now they didn't do any. So when we take 6.5 billion in free cash flow, minus the 1.2 billion in stock-based compensation, we come to 5.3 billion. That is a 13 multiple on the market cap. So let's count with that. Currently they make 5.2 in free cash flow per share after stock-based compensation. Now if we assume they're gonna grow around 6%, plus the 7% buyback yield they will have right now. That gives them a 13% growth. I'm gonna assume here that a slight slowdown happens afterwards. The competition is not gonna get easier. They're not gonna win in market share, so that is already a fairly pessimistic approach. Basically, PayPal is never gonna achieve any big growth. 50 multiple, it's okay. It's a very high margin company, and it still has some growth, so I think 15 is very okay for that. Then you would come to 87, 25% discount from where it is right now. So not a heavy discount. You're gonna make around a 12% return, which is not bad at all, but it's not a very heavy discount. However, it can easily get better. What if PayPal grows a bit faster, Plus, after 5 years, they're gonna squish the competition a bit. Their growth afterwards. That plus an 80 multiple because it grows faster. Then you have a double to 140. There's also 50% downside, because if it gets harsher for them, margins are going to be compressed, basically no revenue growth, only the buybacks, 10 multiple. Now, however, if the multiples would go to 10, then they would also be able to buy back more shares, so you kind of got to factor that in. Then you have a 50% downside. So PayPal is a very great risk-reward ratio. However, it is not as good as it was back then at 53 when I made the video. If it was still at 53, this would be a hand over fist buy. If it keeps dropping to maybe 60, I will probably buy it. I think it would fit great in my portfolio. So what do you think about PayPal? I think it's a fantastic company that has some issues right now, but at this price, it's more than justified. Right down below, have a good day.